Welcome to The Scoop with the River Realty team. Today we're talking about getting pre-approved and down payments. Brian, what's the difference between getting pre-approved and getting pre-qualified?
The main difference between being pre-qualified and pre-approved is the process. Pre-qualified is a very simplified version of a pre-approval, often done online. You can punch in some key details about your income and your debt, and you get pre-qualified to spend a certain amount. A pre-approval is an in-depth look where a mortgage broker or lender look into all of your income, expenses, credit score, and give you a firm kind of number on what you can start your home search on. It's important to remember that your pre-approval still needs to go through the approval process of the home you want to buy, but it does give you a much clearer idea of what you can afford versus a pre-qualification.
Great. And with the type of home that you want to buy, just to clarify, like that means if let's say the zoning is agricultural versus residential, that can affect your pre-approval.
Yep.
Or if it's a condo versus a freehold property, that type of thing
There's a lot of factors that can
affect the pre-approval.
Exactly.
Yeah, so it's definitely important to check your pre-approval number every time you're interested with a property. I tend to, like, when I go out and showings with my buyers, as soon as we know that they're interested in the property, I send the full listing right over to our mortgage broker that's working with us, and then she'll be able to give me kind of an answer right away if they'll be good to go. Yeah. So what are the required documents necessary for a pre-approval?
Okay, so the documents can change again based on whether you're self-employed or not, but the most common ones will be your most recent pay stubs, letter of employment, CRA documents like your notice of assessment. They could also be asking for any tax or any other loans that you have registered to, like car loans, that kind of information. But basically, you want to contact your mortgage person ahead of time so they can tell you what you need, because in every situation it is different.
Yeah, and I always like to tell people there's no need to pull your own credit. I've had clients pull their own credit and send it to a mortgage agent in the past.
Mm-hmm.
They have their own programs, they pull it, it kind of runs scores differently, and that's what they're going to use. So,
Yeah.
Just because you can get an Equifax report, it's not helpful in the process.
They're not going to accept your report.
Okay, that's good to know.
So Sanaz, how much money do you have to put down when you're buying a property?
Well, you can put as little as 5% down on your primary residence, but that can also change depending on your pre-approval, and you can put anywhere up to like above that, right? And then if you put anything under 20%, then you will have a mortgage insurance added to the mortgage, which is just rolled into the mortgage, the payments. And then if you're, let's say, getting a secondary residence, then it changes from there as well.
And are we not able to do 0% down? I've been watching HGTV a lot, and they're often doing that.
That's an American show.
Oh, interesting.
That's a good point. I'm sure a lot of other people think the same, right?
For sure.
Yeah, but the minimum
I've heard
down
it
payment
quite a few times.
5% here. So yeah. And then so how does it work for people like, let's say, first-time home buyers that get a gift from, a spouse, or if they use their money from their RRSPs? Does it change anything there?
Yeah, so you can do up to $50,000, I believe, now from your RRSPs towards that, and you have up to 15 years to pay that back into your RRSPs.
Okay.
And then if you have a gift from a parent or an aunt, an uncle, grandparent, they have to give you a gift letter stating that money is not to be repaid. So it has to be 100% a gift. And then they also have to show where those funds came from. So it can't just be possible, it has to be actual funds in an account for at least minimum 90 days.
Oh, okay. So that's good to know. So speaking of letters, commitment letters, they're good to include with your offer, right?
Yeah, I think it's actually a good thing to include it with an offer, as long as you can give your client permission. Oftentimes when you're doing, especially in multiple offer situations, it shows that your client actually has been approved by a bank. So especially if they're not putting that condition in the offer, it shows that they have been approved for that property.
Or if they have a condition of financing in the offer, it shows that they've already done their due diligence.
Exactly.
And now we know likely the only rest of the work that needs to be done is on the home itself.
Yeah, and with pre-approvals as well. So let's say you get your pre-approval, and then you're looking for a property, haven't found somewhere in how long does the pre-approval last?
They're
for?
usually
3 months or 6 months?
90 days.
90 days, yeah. So after a certain period of time, keep in mind that you do have to update your pre-approval as well.
And the only other time it would change in the 90 days in the event that the interest rates go up or down, then your qualification will change as well.
Yeah. So Brian, do you have any more scoops of knowledge for buyers?
Yeah, I got all the scoops.
Like what?
I think on top of having a down payment ready, you need to ensure you have closing costs available as well. We always recommend around 2 to 3% for our clients to ensure they have funds for lawyers, moving costs, utility hookups, and all those kind of miscellaneous things that you don't really expect. It tends to be over-prepared at 3%, but it's nice to have that if you need the playroom available.
Yeah, and I think the biggest one too is the land transfer tax, which is a big chunk of it, and it's the 2 to 3% on purchase price. Obviously. Yeah.
Thanks for watching The Scoop on getting pre-approved and down payments. Join us next time when we talk about making your first offer.
Bye.